Hello everyone, welcome to Data Science for Buffett Value Investing. You will learn simple and practical investment techniques using data analysis and visualization. When you are investing, you are gambling against the market and you are trying to take money from the market. So the market is not your friend, but your opponent. This implies that you should not follow the market, but contend it. And this is the key idea of value investing, summarized concisely by Buffett's elegant quote. We simply attempt to be fearful when others are greedy, and to be greedy only when others are fearful. Meaning, you need to be counter market sentiment. In plain words, you need to move in the opposite direction against the market. Value investing is built on a key observation of the market behavior. Using Tesla as an example, the market tends to swing between extremes. At the center of the extremes is the so-called intrinsic value, around which the stock price oscillates. At the high point, the market is massively buying and everyone is greedy. So are you, but according to Buffett, you should sell at the lower points. The market is massively selling and everyone is panicking. Although you are also scared to the death, you should buy, as suggested by Buffett. More generally, by the onion theory, the stock price can be regarded as an onion with 3 layers. The core is determined by the company's financial performance, such as its profitability, earnings, growth, and health. The middle layer depends on the environmental variables, such as the interest rates, disasters, and other macroeconomic factors. The outer layer is a red noise driven by the market speculations and sentiments. The intrinsic value of the stock refers to the core plus the middle layer. According to Buffett, it is not a good strategy to buy great companies, but a good strategy to buy great companies when they are undervalued. That is, when the market is fearful, and sell them when they are overvalued, that is, when the market is greedy. But how do you know it is undervalued or overvalued? You must know the intrinsic value or a reference value in the first place. In this course, you will learn how to estimate the intrinsic value for stocks by simple and practical techniques based on data analysis and visualization. The analysis framework differentiates 2 cases, thin versus thick outer layers, and uses different approaches to estimate the intrinsic value for each case. In the case of thin outer layers, the red noise is minimal, and the stock price largely reflects the intrinsic value. Here, stock swings are largely predictable, and predicting the valuation of the stock or intrinsic value is equivalent to predicting the financials and the environmental variables. In the case of thick outer layer, the red noise driven by the market speculations and sentiments may completely distort the valuation. So there's no reliable connections between the valuation and financials. Stock swings are largely unpredictable. And we have to use other techniques such as benchmarking and statistical methods to handle the noise. One example of thin outer layer is Amazon. As we can see from this graph, the market capitalization, or market cap for short, moves closely with the financials. That is the net income, and the correlation is very strong. And so, to predict the stock price, we just need to predict the future financials. The reason behind this cold movement is little space for imagination, as Amazon's business model is well established and quite predictable. One example of thick outer layer is Tesla. From this chart, you can see that the market cap of Tesla is hardly correlated with the financials, and they often move in the opposite directions. We cannot use financials to predict the stock price movements, but have to use other techniques. The reason behind this random behavior is the huge room for imagination by the investors, because the business model of Tesla was changing with unpredictable outcomes. The curriculum of the course consists of 2 parts. Part 1 is the market and industry analysis to determine which combinations to invest. Not every combination is worthy of investing, and they exhibit different behaviors and potentials. Part 2 lays out concrete steps on individual stock analysis to determine which stock and when to invest. We focus on 3 questions. First, how to assess thin versus thick outer layer stocks. And second, how to estimate and visualize intrinsic value for each case. And finally, how to select dividend stocks.